Welcome. You're watching Talking Point. I'm Tamanna Inamdar. Today, the case for our chat is this election rally that we're seeing. Is this already a pre-election rally? We're seeing the markets run up consistently in the last few sessions and really not in tune with anything that's happening globally. Is it election buzz that we're seeing playing out? Also, another question that we're going to ask today from our expert is whether we're seeing signs of recovery in rural consumption. Are those now visible? And do BFSI businesses updates hint at a great Q4? Remember, all of the business updates we're getting in the banking space, especially in lieu of deposit rates and deposit growth, is looking fabulous. Now, to join us in this conversation, we have Saurabh Mukherjea, Founder and Chief Investment Officer, Marcellus Investment Manager. Saurabh, always great to speak with you on NDTV Profit. Welcome back. And let me begin with the first point that I laid out. Are we seeing a pre-election rally, a consistent up move fueled by domestic investors as far as the fund flow data, etc. goes? What is the bet on, considering that the election result has in a way been priced in by the markets?
I think part of the rally, Tamanna, is that Indian large caps are very realistically priced. I mean, we haven't seen a blazing rally in Indian large caps over the last couple of years. So valuations are very reasonable on large caps. Secondly, you're seeing clear signs of economic growth stretching out over the next couple of years. Corporate balance sheets are under-leveraged. Banking system balance sheets are the best shape they've been in 20 years. So the combination of very reasonable valuations on large caps, strong corporate balance sheets, strong banking system balance sheets, and the early signs of a private sector capex cycle. I think those are the core drivers of the rally. I'm not so sure elections are front and center in driving the large cap rally here.
The large cap rally is fueling the markets, and like I mentioned, this is not really on the back of any superb FII participation. Is that something that we could see post the 4th of June once this event is ticked off and done with?
So it's clear from talking to FIIs that they are getting their thoughts together. They're probably getting their corpus together as well, because the combination of economic stability, financial stability, banking system stability, and political stability, right? That's very rare to find in the world today. So if you look at the other large economies, whether it's America or indeed China, the combination of economic, financial, and political stability is very rare to find. So I think it's relatively clear that if there is a showing in the elections where we'll say results in more than 350 seats for the ruling party, we will see very strong FII flows. Even I think anywhere north of 300, I think we'll see a healthy FII flows. So that piece I think is relatively clear. Again, I hark back to very reasonable valuations on large cap stocks. I don't think we have seen Indian large caps at this juncture of an economic rally. Indian large caps at this juncture of an economic recovery as reasonably priced as we are seeing today. So this combination is, I think, beautiful for foreign investors, and hence I would suspect that through June, July, August, we should see bumper FII flows.
All right, so those bumper FII flows is something perhaps that the market is anticipating. So, Arvind, your response on the reasons of why we're seeing this current rally, you also talked about private capex finally picking up after a long cycle and a long wait. I wonder, is there enough evidence to make that play?
No. Right. So look, there are private sector data providers such as the CMI, and they're giving pretty credible data that both project starts and project completions, these are non-government projects. Non-government project starts and non-government project completions have hit record highs in the last 3 months. So I think the last time we saw this degree of private sector capex is, I think, all the way back in 2007, early 2008. The second thing is talking to our investee companies. For example, we are investors in, say, Grindwell Norton. We have investors in Tube Investments. We are investors in RHI Magnesita. They provide ancillaries for the steel industry. Talking to our investee companies who are part of the capital goods capex ecosystem, it's clear that order books, business activities is revving up quite nicely. And again, combining that with the health of the banking system, the health of corporate India's balance sheet, I don't think I have that much doubt that we're seeing the early stages of a private sector capex recovery. So far, So far, post-COVID, it's largely been about government capex. But I think the signs are clear in the last 3 months. The private sector pieces is clicking into place, and hopefully will kick into high gear after the elections. Just a quick disclaimer: all those stocks that I mentioned are part of all our portfolios. Hence, I'm an investor in them via our PMS. So are my parents, and so are our 9,000 clients.
Okay, okay, fair enough. So just to follow up on the private capex cycle, which you're saying now there is enough credible data and private data to say that it is picking up. It would also have to sustain based on consumption ticking up, and that's been one theme, one area of worry: rural consumption, what's happening there. Even when we're seeing all of these updates in sectors like auto or even real estate, it's the premium segments that are still firing. Do you think that's coming next, or are there early signs? Because I know you travel a lot across the country. You travel in Bharat, not just in India. Are you seeing those signs of rural consumption picking up?
So I think on rural consumption, there's two layers to the story. I think the first is the current bout of optimism running around that, hey, look, the monsoons are likely to be good. It's going to be a good Rabi crop, and hence let's load up on rural India plays. NREGA claimants have reduced. Auto sales in rural India picking up, and hence in anticipation of a good monsoon, let's load up on rural India. This is a kind of typical annual cycle. I've seen this in India for a long time. Somewhere at the beginning of the summer, it's kind of habitual for people to start talking about the monsoon. I'm not so sure how much money investors like Marcellus can make from that. What I think is more interesting to dwell on is, I think post-elections, I think in the July budget especially, I think there's going to be lots of announcements focused on reviving rural India. So both on the farming piece and on the employment generation piece, I suspect there's going to be a big focus by the government post-elections on rural India. And I think that it's worth, we'll try to do some more work on that and see, is there potential that, much like the government focused on capex through FY21, 22, and 23 and engineered a colossal capex boom, is there potential that the government engineers a big rural India boom over the next 3 years? I think that's the sort of really interesting piece to focus on as we look at the post-election world.
Let's come to components of this large cap play that you're talking about. And I would say not just large cap, across the spectrum. BFSI seems poised to be the story of this quarter as far as the business updates are concerned. And it's not just an HDFC that is looking good. A clutch of the others as well. Deposit growth seems to have come back. And that was the big concern over the last few quarters, isn't it? Saurabh, what's your take here? And in your view, which are the categories of companies here that are looking like they're really poised for an up move?
So look, on HDFC Bank, we are large shareholders. We've been large shareholders for a long time. We increased our position when the stock came off through Jan Feb, and obviously delighted to see that deposit growth number. We believe they can sustain a stronger deposit growth than most of the banks in our country, given the strength of the liability franchise, given the aggressive branch rollout. They're rolling out 1,300, 1,400 branches a year, which in the context of Indian banking is an astonishing figure. So hopefully the combination of the strong deposit franchise and their legendary underwriting skills will give us the returns that we aspire to see in HDFC Bank. The stock obviously has had a tough time over the last 3 years, but given the growth in the business, we remain optimistic that they will do well over the next 2 to 3 years. But beyond that, I think, as you mentioned, generally the banking sector is looking in good shape. Overall, lending sector is looking in good shape. Asset quality is under control. If the lenders, banks and non-banks, can combine strong asset quality with financing the private sector capex piece, then I think the next 12 months potentially will be the best 12 months for the banking sector in this cycle. Remember, so far the main lending engine has been retail. The corporate lending engine hasn't yet fired into high gear. That will only happen when the capex cycles for the private sector begins. And as signs of that emerge, I think we will be looking to stay heavily invested in banks and NBFCs and Marcellus's portfolios. But beyond that, I think the other sector we are very optimistic on is IT. If you see Naukri.com's numbers, i.e. Infosys numbers, IT recruitment is picking up. IT recruitment is picking up, and that's typically a lead indicator that the IT companies are getting greater visibility on execution, right? The IT companies are pretty smart. They build the order book, but until they see that the client has signed on the dotted line saying execute karo, they don't go and hire staff. So the fact that Naukri.com's data suggests that IT recruitment has picked up, I think is indicative of the fact that the IT companies are seeing a degree of better visibility on project execution on their client side. And that again makes sense. If you look at this, the scorching pace of American economic growth, it does make sense that the big American corporates are telling the companies whose names you're flashing on the screen, the big American companies are telling the Indian IT services providers, boys and girls, begin the execution. So we are optimistic there. We've got a large position for a long time in TCS, and then in engineering R&D, we've been invested in Tata Elxsi and LTTS for a while.
Now, I just want to do a quick follow-up on HDFC Bank, Saurabh, and on the BFSI space. Last quarter, when there was quite a negative reaction to their numbers, and the question was that is the overhang of this merger not completely priced in? Were you in the camp of, listen, hold on, let's wait and watch? Or did you feel a bit of panic as well? And are you today saying, dekha maine kaha tha?
So I don't think dekha maine kaha tha is ever a wise thing to say in the stock market. All we did was we looked at the data, Taman. I mean, the main the data point which stuck in my mind through that whole melee in January was net interest margins, right? So remember the market's concern was कि बॉस इनका डिपॉजिट नहीं आ रहा है फंडिंग कैसे करेंगे HDFC लिमिटेड के बुक का. So we looked at net interest margins. HDFC Bank and Kotak Bank were the only large banks at the end of Q3 whose NIMs were intact. HDFC Bank and Kotak Bank NIMs were intact. Barring those two banks, every other bank shed net interest margins quite aggressively, anywhere between 10 to 30 bips NIM reduction for every other bank, barring these two banks, right? So I found that very interesting that the market is worked up about the liability franchise of HDFC Bank, and yet this and Kotak are the only banks where the NIM is holding up, which suggests that they've got the two sides of the balance sheet in relatively even kilter. And hence, keeping our nerve and, in fact, increasing the position as the shares came off wasn't too difficult. I think both from HDFC Bank's perspective and from the perspective of our large position, there's a long way to go to get out of the woods in terms of funding the HDFC Limited book. To get out of the woods, I think HDFC Bank would need at least 3-4 more quarters of strong deposit growth. To get that book funded, and once they fund that, then we as shareholders have what we need. We've got a big housing finance book, which rather than getting funded by wholesale market liabilities at 7.5%, are being funded by CASA at 4.5-5%, and that's the best place to be in Indian banking.
So do you think that as far as banks are concerned, the favor is tilting more back towards private banks? The story's been all about your public sector banks the last few quarters. Do you think that those scales are tilting?
So it depends on this capex rally piece, right? So if the private sector capex rally begins, which I'm pretty optimistic it will, if the public sector banks take a very aggressive stance in financing their private capex, and if the private sector banks, perhaps scarred by the memories of 2011, 12, 13, stay back, hold back, then I think the PSU banks could continue to outperform the private sector banks. But my hope is, given the strong position that, say, Axis, Kotak, HDFC Bank find themselves in, ICICI find themselves in, I'm hoping that all of these banks get on the front foot in terms of funding private sector capex. Discussions with the banks over the last few months does suggest a degree of hesitancy, given the traumas and the sort of tragic memories of 2008 through to 2014. But again, the banks are run by smart people, and I'm hoping that they'll grasp the initiative, and we will see the corporate balance sheets, the corporate lending activities of the private sector banks. I'm optimistic will step up over the next 3 quarters.
Just a quick follow-up on the IT piece, because again, that's a bit of a debate. Indian IT, is it a good time? Is it not? Are they really poised for this leg of, you're saying, the hot streak in the American economy? Which segment of these IT stocks do you think would be more favorable? Are you looking at the big ones, your Infosys, TCS, Wipros of the world, or then your mid-cap or mid-level IT companies are the ones with the most potential?
So look, from what we are hearing in our discussions, Tamanna, AI and Gen AI is a massive priority for Western CEOs, right? It's a colossal priority. And roughly what we are hearing is for every dollar that the Fortune 500 companies are spending on, say, cloud storage, as a sort of rough rule of thumb, for every dollar that the Fortune 500 companies are spending on cloud storage, their AI spend is going to be almost 10x that, right? So as an order of magnitude, this sounds to me to be the beginning of a 4 or 5 year burst in IT services activity, where the Fortune 500 companies first shift to cloud. Remember, 70% of the Fortune 500 is yet to shift to cloud. So first they shift to cloud, then they start moving to AI, which in turn necessitates a whole a new wave of spending on software as a services. So it looks to be the beginning of a big wave of work for Indian IT. Whilst I'm sure there are mid-cap IT companies who will benefit from bits and bobs of this colossal wave of IT spend that's coming towards India. Our preference would be stay invested in the big names and capitalize on the totality of the surge, right? Almost every aspect of the Fortune 500 IT companies' spend will have to be revved up as they transition from legacy systems to first cloud, and then cloud with AI enabled inside it. So the outlook looks good. We are loaded up. As I said, Naukri.com's data yesterday suggests recruitment engine is also revved into high gear. I'm also hearing from friends in the industry that TCS's recruitment is stepping up. As I said, that's one of our largest investments in the sector.
Godrej Properties up on the back of a stellar Q4 business updates. My colleague Anushi has all the details. Anushi, what has Godrej Property cracked in Q4, and do we have numbers for the full financial year as well in terms of their business updates?
Right, Tamanna. So let me break down both the Q4 and the FY24 numbers for Godrej Properties. The stock has been buzzing in trade on the back of some strong set of numbers over here. So now if you are to look at the Q4 numbers over here, the pre-sales bookings have gone up about 135% over here, marking a value of about 9,500 crore. Of this, 4,000 crore emits from the Mumbai metropolitan region. Now, if you have to look at the FY24 booking number, that is about 20,500 crore, about 84% growth here, exceeding its revised guidance of about 20,000 crore. What is interesting here is that it has also exceeded its own the earlier guidance that it had originally come out with in the beginning of FY24 by a 61% mark. Now, this is the highest ever quarterly sales and the number that we have seen in any of the major real estate players over here. These key projects are supported by, first is the Godrej entry into the NCR region, which had a booking value of about 3,000 crore. That is the Godrej Zenith project. And the second is the Godrej Reserve project in the MMR region with a booking value of about 2,690 crore. So overall, if you have to even dissect its booking values, about 4 projects have exceeded the 2,000 crore mark in the FY24 period. So this is supporting the kind of growth numbers that we are looking for Godrej Properties, and one of the primary reasons why the stock is buzzing in trade today.
Right, thank you so much for that, Anushi. Now, Saurabh, we just wanted to get that report in because look at the focus and the kind of business updates you've seen in the real estate players. And the question always was, is this sustainable? What segments are really buying? Where are inventory levels? What is your take on some of these counters?
I mean, look, specifically for Godrej, whilst we're not shareholders, I think Pirojsha and team have done a wonderful job in building not just a brand, but a reputation for great build, reputation for timely delivery. My reading is that standing them in great stead in key markets like Mumbai and Delhi. They've built enormous fan following, and which is why I think you're seeing these bumper numbers. More generally on real estate, though, my concern has always been that do you really have pricing power in real estate anywhere in the country? Because barriers to entry into the sector are relatively low, it tends to be difficult to generate a high return on capital. Because you can't generate strong returns on capital, your surplus cash flows with which you can drive your future growth tend to be relatively modest. So applying that to our key markets, again in Mumbai suburbs, I'm hearing of enormous supply coming on stream over the next couple of years, and I'm not so sure the amount of supply that's coming on stream, whether there's going to be commensurate demand. I suspect Mumbai real estate once again has got into a situation where optimism on the developer's part is bringing plenty of supply on stream. So it's the age-old cycle in real estate. A cycle is all right provided through the cycle you're able to generate surplus cash flows. I've always had question marks around Indian real estate on the ability to generate surplus cash flows through the cross cycle, because without surplus cash flows you cannot finance future growth. So our preference has been to play this epic real estate boom through building materials, and so investments like Pidilite, Astral Poly, Asian Paints, Serra Sanitary Ware have been part of Marcellus's portfolio for a long time, and we're hoping that they'll have a good 4Q and then a good FY25 as the real estate boom continues.
Yeah, so tread with care when it comes to real estate. Just, to round up, we were talking about government capex picture becoming clearer in the post-election budget, perhaps in July. And I just wanted to get your take on some of the run-ups we've seen, or a revival actually in the defense play, railways, whether it's a Garden Reach or Cochin Shipyard, all of these have really been firing. Would this also be a tread with care kind of a call?
So look, on government capex, I don't think the FM could have been clearer in her vote on account on 1st February. She said very clearly that last 3 years, government capex grew at around 30-31%. And in the vote on account, she said that in F25, it's likely to grow at 11-12%. So you're going to see a step drop in the intensity of the growth in government capex, and that's only justified. Remember, post-COVID, when the private sector capex was really not going to happen, the government stepped up and revived the economy. Now that the capex engine the private sector capex piece is firing into life, it makes sense for government to take a step back. So in that context, how sustainable the rally in many of the PSU capex plays is, I'm not so sure. And in that context, defense as well features in that. Clearly, there is an imperative for us to spend on defense given the situation with China specifically. But how sustainable the last 3 years of 30-35% growth in defense capex every year is from a fiscal standpoint, I'm not so sure. My preference has been to focus on private sector capex, and at long last, it seems that private sector capex is turning the corner.
Last quick question to you, Saurabh, and I know bits of 2023 were tough for you. You faced a lot of criticism on performance of some of your funds, small cap. Maybe some of it didn't work out. Do you get a sense 2024 is going to be very, very different?
So FY24, ironically, for a large cap product was all right. FY24, our large cap product CCP gave around 24% net of fees. Our small cap product FY24 gave 0% net of fees. So from that perspective, Tamanna, it's difficult for FY25 to be worse. In jokes apart, the small cap product has revved into life over the last few months. The mid cap product is also doing well. Large cap product by design is meant to be consistent. It's called consistent compounders for a reason, that it's meant to be staying, returns are meant to be in the high teens, low 20s area. And they've been like that. FY23 was tough, but FY24, things have turned the corner. And similarly, in a similar vein, we have an all cap portfolio called Merit or Q, which has been gunning out high teens, low 20s returns as well. And I think that's our job. If we can keep returns in the high teens, low 20s, when people oscillate between 30% and 10%, Marcellus stays in the middle, we should be all right.
Yeah, I must say you've taken it on the chin and responded very honestly about everything that came your way. So we're looking forward to seeing great things from you and speaking to you again soon. But for now, thank you so much for joining us. Saurabh Mukherjea there on how he sees the current rally pan out. That's all the time we have on Talking Point today. We'll take a very quick break, but stay tuned. A lot more coming up on the other side.